Hello and welcome to another Securities Lending Saturday. I'm Roy Zimmerhansl and I'm your host. Today I'm going to be talking about a review of the Future Tech panel at the recent Securities Finance Tech Symposium. Look, technology is at the heart of everything today, no more so than in the securities finance space. So I'm going to be reviewing what the experts had to say and what their thoughts are for today, tomorrow, and the future. So if securities lending is your thing, if you are a lender, a borrower, an intermediary, part of the infrastructure, a vendor, or you're just plain interested, then this is the place for you. So let's get started. So as I said, today we'll be talking about the Future Tech panel at the recent Securities Finance Symposium. This is part 4 of 5. Next week, I'm going to be doing the DLT. I'll share my screens with you as per normal. This is what we'll be talking about today. First of all, is security behind the curve? Secondly, measuring success in future tech. If you can't measure it, then it just doesn't count. Great discussion on how long will that transformation actually take. A discussion on the impact of the failure of the industry to transform, DLT and CSDR, a couple of questions from the audience, which were great, and the excellent moderator, Gabriele Frediani, asks the panel to prognosticate 1 year from now what success will look like. As I said, that's what we're going to be talking about. Here's the panel. Gabriele Frediani from BondCliq did an excellent job moderating. You won't hear me mention his name very much during this session, and that's actually the act of a good moderator. He definitely cajoled all of the people to give interesting, insightful, and sometimes challenging comments. But look, no question about it, he is a top moderator and an expert in securities finance in his own right. David Shone from ISLA, Ken DeGiglio of EquiLend, Martin Walker of Broadridge, and Wassel Dammak from Vermeg. I know all of them, have been on panels with all of them with the exception of Wassel, so I hope to meet him at some point. So that's the panel. We get talking about their comments. If this video or other videos have been helpful to you, I'm glad that I do them. What I'd like you to do is give me a thumbs up on whatever platform you're watching it on. That helps me know which videos work for you and which ones I'll focus on to do more in future. If you want to be aware of all of the videos that I have, subscribe, of course, and ring the bell, and you'll be notified every time I post a video. Right now, I'm still at one. I hope to pick that up, but it's a matter of finding time. But at least once a week, you'll get a new video. Now, let's go to the meat of it. Gabby suggested to everyone that, look, the real challenge here is, where is securities finance in the spectrum? Are we behind the curve as compared to other parts of the financial markets? And that's really important because, look, if we want to have a thriving industry that survives and plays a meaningful role in the future, it has to be relevant and timely. And if the technology is falling behind and we aren't keeping pace, then maybe other products, other services will actually pick up the slack and maybe even replace securities finance with some other methodology of achieving the same economic goals. So look, there were a lot of conversations here. I've picked out a few things. One of the things is Martin Walker outlined that if you compare it to FX and equities and derivatives, just as an example of 3 other areas, then it's unquestionable that securities finance is behind the curve, and I 100% agree with that. I will revisit that though, because I think there's a bit of wishful thinking going on in the community in terms of just how far you can proceed. But he's dead on with the point that compared to those products, if you look at things like electronic trading, standardization, and particularly data-driven decision-making, securities finance is behind the curve. A lot of the discussion was about collaboration throughout the whole panel, which I thought was really interesting. And I think what we actually saw with SFTR in Europe was a tremendous amount of collaboration amongst peers, competitors, service providers, vendors, trade associations. And that's one of the reasons why it was such a successful rollout. And the interesting thing that all the commented on was that this whole sort of transformation into future tech is really reliant on similar collaboration, cooperation, and participation. So that's a theme that was throughout. Ken gave a great phrase. What they try to consider themselves at EquiLend is that they're born digital. And one of the other questions or topics that came out all the way throughout is this whole sort of transformation. Are we just throwing away everything from the traditional asset or financing world and going straight to a new thing? And the answer to that, of course, is no. And there's some great points made by David saying that, look, traditional finance can learn a lot from new finance or digital, however you want to phrase it, and vice versa, right? So, for instance, one of the issues that I've spoken to many people about is that while crypto is a growing asset class, although it's been certainly a declining asset class in recent time. Like it's probably not going to go away. But you haven't seen that same penetration into the institutional community. And that's because all of the infrastructure has been tried, tested. It's been through defaults. It's been through court cases. It's been tested around the world. There is certainty of protection of assets if they're handled in certain ways by custodians of assets. That doesn't exist in the crypto world yet to the same degree. The amount of insurance and coverage that you can get is limited compared to the same sort of for assets that you would find in a traditional asset world. And so you're not going to have that same participation. But these things, of course, will come. Ken asked some great questions throughout there. Is Web 3.0 real? Is crypto here to stay? And does DeFi, will it actually take hold and change the way that we do things? And one of the questions, again, that often comes up is, will we live in a disintermediated world? If I step back and I look at the participants in the digital asset world, it's just one group of intermediaries has been replaced by another group of intermediaries. Doesn't mean that it'll be that way forever, but it certainly appears that there is always a need for intermediary expertise, access, volume processing, volume discounts, pricing. There's lots of reasons why you see how that the brave new world that lies in our future might actually mesh these two things. And so it's not we're going to stick with the way things have been done, and it's not we're going to throw away the stuff and only go with a new digital world. It's probably some kind of a combination of the two. And one of the key things that I think Wassel was talking about was this whole issue of requirements for transparency in real time. And again, that's a common theme that we hear. But one of the things I thought was very interesting with all of his comments was he was very practical and gave some great examples of each of these issues. And he was talking about collateral, for instance, and having to move things real time and knowing on a more clear-cut basis what your inventory, where it is, and how to optimize it. Some good stuff there. The other thing, proof of how things have actually been moving on. There's much more acceptance of SaaS and cloud. And of course, APIs have been having a growing impact for probably a decade or so. So look, there's lots of things changing. I think there was agreement on the panel that it is behind the curve. However, it is speeding up. It is moving forward. And that's the real challenge that faces everyone, is how does it keep pace with the wider world and actually not just keep pace, but try to catch up from being behind. So that was a great opening question. Then they moved into measuring success in future tech, because of course we're just saying, let's do tech for the sake of tech. There's not a lot of point in that. And you won't certainly attract the investment money that you need to really develop, invest, and grow and enhance your business. And so I think Martin put it bluntly, but quite correctly, saying that, look, what the market participants are in for is loss P&L. They're there to improve efficiency, and they're there to reduce or at least manage or be aware of what risk is. So the real test of any applications is, does it satisfy one or more of these areas? And I think that is completely spot on. And how do you do that? Again, standardization is a a theme that has been in the industry for some time, but been very difficult to implement. So again, ISLA and trade associations have been working to try and standardize things, specifically in securities lending. ISLA has been taking the lead on the common domain model, and that was and the whole idea is, unless you have more commonality, more standardization, more harmonization, and then interoperability, as it says, you can't really make the most of any kind of technology that you actually have. One of the things that again Wassel talked about was this whole idea about leveraging and enhancing existing technology, right? It doesn't mean that you have to completely throw everything out, and you can only find solutions once you have DLT or some other technology enhancement. You can actually apply what's already out there, make the most of that, and then find incremental ways to improve that, which is exactly the way to approach it. And again, the example he gave is for solutions that have standardization and cooperation and interoperability, is the Eurosystem collateral management system, which comes in November of 2023. That'll be used in the Euro payment system to actually manage collateral and keep funds transfer and keep money moving effectively. And that kind of brings 19 central banks throughout Europe into one sort of common platform or methodology. So that's, again, a great example. Ken came up, I think, with a fantastic phrase here: collaboration while competing. Because, of course, while we want to collaborate and while we want to have standardization, the reality is we're still competitors. And so you have to look at these things and say, is market inefficiency a way for some firms to actually leverage their competitive advantage? And I would tell you, I think that is correct. So it has been good to see the active engagement of many firms for whom the inefficiencies are actually an advantage right now, yet are still engaging and trying to make it a better market. One of the things that I think a couple of the panelists, but this might have been David here, was talking about was that if we're still going to be talking about spreadsheets and telephone calls, what we actually have is failure, right? That would be a mark of failure. Now, I kind of support that. I think that's largely true. But of course, if we go back to comparing it to other parts of the financial markets, the truth is, if we can say equities, there's still spreadsheets used in equity floors, not to the same degree, not in the same way, not as much of a dependency for operation, more in specific situations where that's the most expedient way to address it. But there's no such thing as no spreadsheet in equities. Or FX, probably a little bit less, but I've seen in recent times people still relying on spreadsheets for activity. And derivatives, often because they're so bespoke and individually targeted, of course, derivatives is a massive phrase. That's one word that covers so many different products and so many different asset classes and so many different transactions. It's almost careless for me to use the word derivatives because it's so broad. And so there's no question that there's still spreadsheets being used. So the thought of eliminating spreadsheets altogether, I think, is not correct. It's a meaningless target, because that won't happen until something better than spreadsheets for one-offs comes up. And telephone calls, I think a lot of what we talk about with technology is taking away mundane tasks to enable people to actually improve relationships. And there was a good comment that will come on the next panel. So look, measuring success is about making incremental steps forward, becoming more efficient, having a better P&L as a result of that efficiency, and doing all of that while managing your risk more effectively. And so if we continue to rely on spreadsheets, I think that is correct. If that becomes a cornerstone of the business, or stays a cornerstone of the business, I should say, then clearly that would be a failure. But if it's a very specific circumstances that are custom situations, then by definition, you will continue to need those one-offs. A really important question that we keep debating is, how long will the transformation take? I'm going to have you hold on for a second there, because I need a drink from my non-sponsor, Coca-Cola. Hold on. Okay, I am back, and you didn't have to hear me drink it. So, how long will all of this transformation take? I think this was a fascinating sort of discussion, right? Because everyone, I think, agrees is that there is technology that exists today. Nothing new needs to be created that would help generate P&L, that would make the markets more efficient right now, and that would manage risk more effectively that are there today. And so the idea is they haven't actually been implemented to the greatest extent. They haven't been adopted as standard products or standard methodologies. And that's where the challenge is. So I think standardization came up again. Ken made the point that, of course, change is not easy. It's not straightforward. It's not cheap. The reality is that, again, one of the things is that it's not really the technology, not the adoption of technology that might slow things down. It's actually the human related issues, the budgets, the people, the personalities, the job insecurities, possibly even. Those are the issues that delay, defer, or drive a faster pace of change. And he made the point that there's no question that there's a war on talent. There's also a requirement to reskill people as the markets change. One of the things that Gabriel talked about was this whole thing about regulators taking pieces of legislation from other products and trying to force feed them into securities finance. And where I thought he was going to go with that topic was to say that does that throw up other technology challenges, or does that mean we can take technology from other business lines and adapt them to this? But in fact, that's not really what he was talking about. And that sort of generated a further conversation. And we were talking here about really the paradigm shift of the business, and that the technology exists there today at the pace of change is accelerating in such a way it's markedly different to where we were 2 years ago, let alone 5 years ago. And so the speed changes. And I think the interesting point there is exactly that, right? Because we've learned how previous technology implementations have worked and haven't worked, you learn along the way. And so in many cases, being a late adopter is an advantage, not a disadvantage. Of course, it's a disadvantage before you adopt it, but actually coming in slightly later and then actually accelerating, you've learned all of the mistakes of the previous people. So you get to actually build on the shoulders of your predecessors. And that kind of helps speed the pace of change. And I think it was Gabby that kind of got off by saying that there's no excuse for not being successful. It requires investment, though, and it requires the willingness, desire, and the action to adapt your business to the future. And I think what we've heard a couple of times is people talking about firms from outside the industry coming in if we as a securities finance industry don't drive the solutions that are required. So I hear that. Frankly, I don't care. The industry needs to change, and either the industry participants will actually change it or other firms will. Either way, it's going to change. Question is who does it. And so I think you could also say that many of the vendor firms that are involved in the business today weren't necessarily in this business or parts of this business 5 years ago, 10 years ago, or 20 years ago. So are they industry outsiders, or did they have solutions and now they're industry insiders? So I think that's part of business. That's part of life. You have participants come in and solve problems that haven't been solved. And if they do that successfully, they will become insiders. They'll become part of the business. But look, the bottom line on a lot of this conversation was the expectation is that a year from now, things will be different. 2 years from now, things will be different. And certainly less than 5 years from now, there will be substantial change. So it'll be interesting to come back and test this. For those of you watching this video, this is in 2022. So if in 2024, everything is the same, you'll know that the industry has failed. But I don't think that's going to be the case. And quite right, Gabby asked, what's the impact of a failure to perform? And I think David started off by just saying, look, the reality is it's a bit of a truism that you have to continually adapt or die. And frankly, that requires the budget participation and it requires the desire to actually do it. And Wassel gave a great example of kind of incremental improvements. So, for instance, replacing email in margin movements, right, in the margin calculations and the communication with your counterparties, and talked us through quite a nice pathway of how you would take something and replace it. So I think that was a great example. There is one area that I had that I have a disagreement with David on here. One of the things he talked about was that some of the regulation that came our way was because regulators asked the industry for information about its activity, its volumes, its exposures, and the industry post GFC failed. And I think that's true. I think that was the case. So what David's solution to that is, look, if we capture this data, if we can standardize and harmonize, and we have data models that make it more transparent and normalize information from multiple firms on different platforms in different countries, then what we can do is we can proactively go to regulators and offer standardized data for them to interpret rather than have them dictate to the industry what the regulator wants. And I think that sounds good on paper. I think the reality is regulators respond to the last crisis, right? So when there's a crisis, they try to fix the items from the last crisis. And so that's what brings out often new and different requirements, whether they're completely thought through or not. If regulators think that will fix the problem, those are the regulations that they bring out. So you can offer up whatever you like, but that doesn't solve the problem. Regulators will always come out with new requirements because their own political and regulatory objectives can change from time to time. And that might be in their own country, it might be in a region, or it might be a global movement. So you can't, I think, do that. What you can do, as he was talking about, is by standardizing the data, it makes your response times more quickly. So it gives the real impression that you actually do know what your business is doing and you can manage that. So that part of it I agree with. If that was, and we were saying securities finance is behind industries such as equities, then you would, then on that same basis, you could say that there shouldn't be any new regulations around equity markets. And of course, there's always new regulations. So you can't preempt anything. You can just respond by being more interactive. And I think the trade associations do a great job with that. And when asked for information, if you can produce that, that might slow their desire to rush in a regulation. They go, oh no, this industry really does know its numbers. It looks okay to us. Maybe that's not a priority for us right now. So I have to take a little bit of a different path on that same topic. But clearly, no one wants to fail in this. And I don't think that's an option. I think if you fail as an industry form, you will be left behind because other solutions will be more cost effective. I think that's perhaps the bigger issue from my perspective. Then there was a good conversation about DLT or blockchain as it was incorrectly used interchangeably at times in our wider conversations in the marketplace, and a couple of different perspectives. I think Ken was talking about originally when we were talking about DLT, then was, is this a solution looking for a problem? And I think he gave a great example where he said, look, if that's the case and you're looking for problems to solve, securities finance is the place to be because there's lots of things that could do with being more efficient, more timely, more transparent, whatever you want to describe it as. I think that was a great phrase. Martin kind of flipped that on its head and said people have a little bit of DLT fatigue because it was touted as the solution for everything. So not necessarily solutions for specific things. And what he pointed to then was some Broadridge products, but more importantly, the point of saying what it is definitely a solution for specific things. And as long as you're focusing on solving those specific problems, that will help drive the investment and innovation and application of DLT, and that in itself will grow over time. There was another question on CSDR, so I lumped them together on this page. A question from the audience saying, will CSDR penalties force in technology and drive solutions? And I guess the answer from Wassel was, yeah, they already are. right? That there's already a clear pathway where people have actually invested, implemented, and improved their operations. Again, I think a good example of how regulation can drive efficiency at times. Again, one that Ken made was that about securities finance, just the contract structures, the life cycle management really lends itself to kind of standardization. And so DLT, going back to that point, is really a useful application for the business generally. And that's why we've seen progress in those areas. So Gabby wrapped up the session by asking people to describe next year's panel and what would you expect to see about securities finance. One of the comments from Vassel and artificial intelligence are the two most likely technologies to make a difference in the coming year. Those are the things that are closest to actually improving the business as it is today. Ken, I think, David talked about the implementation of common domain model, the open source repository that actually will help make CDM more straightforward application, and also talking about not just talk, but actual action towards standardized documentation to support sets. That would be his measure for a year from now. So not necessarily having it in place, but certainly having progressed a long way from where we are today. Ken was very clear. They have a product, a suite, or whatever you want to call it, one source. I don't know if that's how it's spelled or some fancy version of it that's trademarked or something. But look, that's all about scale and efficiency. And they have a world image focused on having that sort of not quite a golden source as it's used in other places, but having one source for information. And by having that, you're able to build scale and efficiency and thereby reduce costs. And whether that increases volume or makes the existing volumes more cost effective, it's immaterial as long as it makes an improvement in the place. And I think Martin wrapped it up by saying, look, what we want to measure is a measure of the movement to electronic trading, check and see what's actually happened to settlement fail rates. And for DLT, moving past sort of proof of concept stage. Lots of people have lots of great ideas and have proven individual use cases, but can that actually be moved into, again, Martin was talking about removing spreadsheets, and I think removing spreadsheets is the right way to describe it rather than eliminate spreadsheets. As I said before, I don't see how you can do that. And ultimately, Martin also made the point that you have to measure the rate of change so that you can actually see, are you actually catching up? Are you on the way that you need to be to where the industry needs to get to? So measurement is as important as the practical steps to get there. Okay. Oh, these were the final bits. So is securities finance behind the curve? I think the answer was yes. Measuring success will be the degree to which you get more data-driven decision-making. It will be a measurement of the degree to which you can eliminate spreadsheets to either eliminate phone calls or enable more productive phone calls, get away from managing at the transactional level and become more of a risk manager or a business generator. How long will the transformation take? I think everyone is very bullish that this pace of change is picking up and that the only thing that's likely to hold that back will be non-technology related factors. So budgets and decision makings and prioritization. The impact of failure to transform clearly means that risk remains in the business, clearly means that volumes will be impacted because the cost savings won't actually be there, and also means that firms are potentially going to be displaced. DLT, again, a lot of very solid support for very specific applications to solve the problems where DLT is uniquely designed to fix it. And 1 year from now, I think everyone would be expecting to have had surprisingly good progress on the technology front within the next year, which I think is good, especially as we're coming up to budget season at most firms. So we'll see how much money to actually set aside for that next year. So just going to go to the final. As I said, this next week, I'm going to be talking about the DLT panel, and that will be the wrap on the symposium series. So I hope you enjoyed it. As I said, I am back. Oh, we got a question here. How do I feel about the SIFMA proposals on T+1 and the tech implications? Sonia, that's a great question. And I wish I had an answer to that, but I haven't had a chance to actually review that. So I don't know, but it's something I can look into, and I'd be happy to talk to you about that. So thanks for that great question. I don't know if you have time to share your own thoughts on that, if you have time to jot them down, or what you think the big questions are or whatever. I think everyone would be interested in seeing that. I'd share them up on the screen, but I don't have an answer to that question. It's not often that I say that. But look, that's it. Okay, so thanks very much. Appreciate you watching live or on replay. I'm Roy Zimmerhansl. I am going to probably go out in what is raining now after a great week of weather and enjoy the rest of my Saturday. To everyone that's a father, happy Father's Day for tomorrow. Enjoy your weekend, enjoy your week, and I look forward to seeing you next weekend.